Welcome. My name's Chris Gosselin from Australian Fund Monitors. My guest today is Nichols Chaplin, Director of Seed Funds Management and Portfolio Manager of the Seed Hybrid Income Fund. Nick has over 30 years' experience in the finance industry, specialising in structuring and education, and with a focus on hybrids, including time with NAB, CommSec and Westpac, building their hybrid capital businesses. Welcome back, Nick.
Thank you, Chris. Nice to be back.
Nice to see you again. Nick, a month ago in the middle of September, the financial regulator APRA surprised the banking and financial sector by proposing to phase out additional Tier 1 bonds issued by banks in Australia, giving as their reasons concerns about the potential risk to banking stability and thus to retail investors. When we last spoke, you mentioned that APRA was seeking feedback from the market. Has it been positive? And if it hasn't been positive, why not?
I've only got two answers for you there, Chris, and that is there's been no response from some of them. I think the submissions have until the 8th of November to be in, but there's been a lot of discussion in the media that hasn't been very complimentary about this. I think we need to give suitable respect to APRA on the basis that they're the regulator. They've done a great job actually for 25 years since they took over this role from the RBA in '98. We'd hope that there's some issues here that they might be open to thinking about. So we're looking forward to actually meeting them today in an industry roundtable. And in that discussion, I would hope that there is, more than a dozen brokers, fund managers going in to speak to APRA. They're represented by a number of people in different cities. And we'll be hoping to discuss some of the things, the dangers to the banking industry in Australia, which has been held in such high regard for such a long time because of their capitalisation, their liquidity, their balance sheet management. And there are some dangers with this proposal to those very good aspects.
So what do you think APRA's response will be to obviously a certain amount of criticism, assuming, you've been critical of it and certain others have. So how do you think they'll respond to that? Will they respond positively, or will they just say, we're the regulators, so eat it up?
There's always a danger of the latter. I hope they'll see it as constructive criticism. I hope that they see it as, have we missed something in doing this? Remember the proposal that they've come to, which is to phase out between 2027 and completely by 2032, just the bank hybrids, not the insurance, not the non-financial issues like the challenges of the world. I hope they can take some time and think, all right, well, let's hear from the guys that have been doing this since we really started. Is there something we've missed? Because this is something that we've just come out with. It wasn't one of the original proposals really a year ago when they put the first paper out. So it's been a bit of a shock to the market. I know that there has been a lot of critical press. There's been worrying about if APRA's concerns is about retail participation in this market, which really, if you talk to the brokers, is about 30%, not 50%. Remember, APRA has publicly stated that the equation for working out retail participation is based on the size of a trade. But I know plenty of sophisticated investors who trade less than $500,000 because they're working with self-managed super funds. Mm-hmm. So that's erroneous to do that. So we'll just gently point this out today. We've got an hour with them. And I'm hoping that they'll take this in and maybe take a step back and think a little bit further about it. We're not suggesting for 1 minute, you're utterly wrong. Why did you do this? What have you lost your mind in the last year? Having had a good position on these things for 25 years. That's not the approach. I hope it's a constructive discussion with them.
And which parts of the market are missing out? Is it the retail investor or the institutional investor, professional investor that is missing out or will miss out as a result of this? Or is it the banks themselves because they have a reduced form of capital or reduced form of funding?
Oddly enough, the banks are probably, I know that talking to at least two of the major banks, they're not thrilled about this because what it does is weakens the capital position. They are thinking about their customers as well. If it lifts costs, If you're replacing AT1 with Tier 2, which is debt, you're gearing up. That means that your costs are going to be higher potentially if you influence the credit rating on your instruments. And Standard & Poor's have already said that they would likely downgrade the Tier 2 instruments of the banks if this goes ahead. That increased costs, and you know where those go, straight to the consumer.
Sure.
So I'm not sure the government would be thrilled about that. But I think really the ones that miss out are the investors, family offices, high net worth individuals, self-managed super funds, all of the, and there's $1 trillion in self-managed super in Australia, plus these investors, and there's many more categories that typically have made this listed hybrid market so successful for a quarter of a century. And yet you've got other branches of government like the Waratah bonds from New South Wales, the simple corporate bonds which were introduced federally as a way to spur the domestic listed market for bonds, fixed income, and they've failed. They just haven't gone out and worked. Ultimately, this one has worked from the word go. It's worked for 25 plus years, and here we are with a suggestion that we'll shut it down on the risk that Credit Suisse occurs here.
Sure. It seems odd. If it's not broken, why try and fix it? Would be some of the arguments.
Yes.
What has happened to prices for hybrids and other forms of prudential capital since APRA's announcement?
Well, we've seen a market tightening in Tier 1 prices. So the margins have come right in. I'd say right now, typically you've got about 100 basis points between hybrid capital or AT1 and subordinated notes Tier 2 issued roughly for 5 years by the major banks. That's down to about 30 to 40 points now. So very, very tight. And when you consider that hybrids are issued with franking credits included, the cash cost of Tier 1 is actually cheaper than Tier 2 at the moment. That can't stay. However, if APRA proceeds with this proposal, you've got a situation where they want the hybrids that are already out there in the market to absolutely come off at their call date. So they've assured the public of those call dates now. That was always an inherent risk. They've turned the hybrids virtually into a bond, which means that they would be less risky and therefore they'll trade tighter. So it's a natural, and that's actually one aspect of this whole thing that I'd hope APRA step back and listen to or look at, and that is we've seen prices and margins for hybrids wave up and down over the last 25 years when something has occurred. It's incredibly efficient. I would suggest it's more efficient than the equity market. So when COVID came through, we saw hybrids drop down in prices, margins widened for about 2 months, and then it shot straight back up as people realised there's nothing to this. Equities took a year. So we're not really about being interested in shutting down an efficient market. So it's another aspect to this.
Okay. Turning to markets in general, let's leave APRA alone for a moment. What's the market doing regarding announcements from the RBA at the moment in direction of interest rates?
Well, there's a growing call now for rates to drop. I mean, we've seen the CPI numbers coming out, albeit in monthly numbers more recently. We'd like to see the October quarter or the end of September in October come out, showing a marked decrease in inflation. If that has occurred, then there is the capacity for rates to drop soon. I know we both have different views on this. Mine tends to be, I don't believe the RBA will move until 2025, and that's just really driven by not wanting to bring the ghost of inflation back again too soon. Let's make sure the job's done. We didn't, being fair, I don't think we went hard enough early enough, but that blame could be put on a number of jurisdictions. But there are other jurisdictions that have moved their rates that could provide some momentum for the RBA.
Sure. Certainly, the RBA has been, as they use that term, resolute. They've been resolute in their determination to stamp out inflation, and therefore the expectation has been, as you say, nothing until 2025. I think the other thing that comes into it is that Michelle Bullock's predecessor got absolutely slammed for making predictions.
Yes.
That rates weren't going to rise. I think the RBA is probably now very hesitant to give any sort of signal that they can't follow through with. So I'm sort of 50-50 on whether there may be a rate cut before Christmas. I'm certainly not convinced of it.
I'd certainly welcome it, Chris, but it's just whether it's prudent at this time. We've talked about the political angle too. There's an election that has to happen before May. That would be a benefit to the government if rates did drop. But I think the RBA and Michelle Bullock's been pretty good at showing that resoluteness. That we'll do it when it's prudent to do it, not because something's happening.
Sure. So as a result of all that, is there an increasing justification for duration in investment portfolios, of pushing things out or not?
I get that message a lot. People are saying, well, surely rates will drop soon. We're starting to get monthly CPI numbers under 3. If that becomes a consistent thing, it's when do you prepare for that? The fund that I run, the Hybrid Income Fund, is 98% floating rate. It's not a high duration fund at all. That's a decision that I've taken on the basis that floating rate bonds perform whether rates go up or down. They do what everything else that goes into a bond's return, the credit analysis, etc., works whether rates are up and down. You get this enhancement for a period, a brief period generally, when rates might move down sitting in fixed rate. But the lost opportunity waiting for that to happen can be costly, can be amazingly costly for you as an investor. So we purposely stay away from that argument. No one knows when the rates will start to drop or how far they'll go. I'd be fairly confident in suggesting that we won't be going back to a 0.1 cash rate anytime soon.
I'll back that.
So there you are. So the reason to be not in duration when rates went up, I'd say it could be even half as much of a drop over a longer period of time potentially. If the economy starts to really behave well, reacts well to the rate drop, and we have had some resilience in this economy, particularly with the unemployment rate, then you've got a situation where rates might need to rise again. So I'm always wary of that. But to answer the question, I think there would be definitely some investors preparing for this. I would simply say, though, people have been trying to prepare me for this for about 2 years since rates rose, or 18 months, I should say, since the rates started to rise. So for those that play duration, probably a good thing to watch.
Sure. Okay. Nick, as always, it's great to talk to an expert in the field, and thank you for your time.
It's a pleasure, Chris. Thank you.
Good luck today with APRA.
Thank you indeed.
Okay. Bye.